Hello and welcome to our first ever webinar and live event for Froggy Companies. Thanks for joining us tonight. We're here at Front for Sellers in Woodboro. Thank them for hosting us. For anybody here live, please grab a glass of red or white wine on us. We need some people to stumble in out of the rain here into our location, or we're going to look like bootleggers when we leave here tonight with all this wine. What we got planned here, starting at 6:15, we've got Dr. Jeff Anzalone, also known as the Debt-Free Doctor. He's a periodontist from Louisiana, successful real estate investor, and he's got about 6,000 subscribers for his channel, Debt-Free Doctor. You go check out some of his videos. And Jeff is really good at articulating principles related to passive investing in real estate and creating multiple streams of income. So looking forward to Jeff coming on here in a few minutes, and he's going to be talking specifically about tax advantages of investing in real estate. And that should take us 15, 20 minutes, and then we'll take some questions from anyone who has them. It might just be me asking a lot of questions because I like to learn from this guy. And then after that, we have Zach Silver coming in, and I think Jason from Madison Realty Trust might be joining him. And Zach, Madison Realty Trust is one of the largest providers of self-directed IRAs for investors. And Zach is going to be talking about how you set up self-directed IRAs, tax advantages of them, the process, and some benefits related to that, and specifically related to real estate, the realm that we're talking about. So after each discussion, like I said, any one of us can ask any questions. The online people can call in, or you can chat a question as well. And while we're waiting for a few minutes, I'm going to introduce myself and Froggy Companies. And I want to share some thoughts about what I like about real estate investing and why I turned into this as a second career after being a systems engineer and Air Force officer, a previous 25-year career that I had, and why we created Froggy Companies. And specifically, I'm going to talk about the many ways that potential investors can work with us. So then after Dr. Anzalone gives his discussion, after he and Zach share knowledge with us, I'm going to speak to you all again about our diversified investment approach, specifically with Froggy Fund 1. But although Froggy Fund 1 is for accredited investors only with a $50,000 minimum for shares, excuse me, whether you have no money or as little as $5,000, you can work with us along the way. And this isn't like a timeshare event where we're trying to pressure people to do anything at the end. Obviously, we're here to just market Froggy Companies, tell you some stuff about what we do, and hope you get involved in real estate investing to meet whatever needs or goals you have. So, if I didn't already say so, I'm Jim Froehlich, founder and managing partner of Froggy Companies. We're a small family business. My wife and I started it in 2018. And it was first as like a hobby and a side hustle, more or less. Because, like I said, I was 6 years Air Force officer. Then I was the next 19 years consultant for Department of Defense and Homeland Security, and I did stuff related, a lot of interesting things related to national security during that time with ground stations and other fun stuff, I'll just say. But I've always wanted to get involved in real estate, and we were interested even in the mid-'90s. We had a couple false starts with multifamily. So most people hear about real estate, I'm going to do something in real estate, or they're interested. And the first thing they think is, well, I'm going to be an agent or a broker, or I'm going to buy some properties and we're going to rent them out. And that's like the tip of the iceberg in terms of what you can do relative to real estate as either an active investor or a passive investor. So like I said, I started this as a side hustle, turned it into a full-time job in 2019 with my family. And then since that time, I've been general partner on over $450 million worth of projects related to real estate. And I've consulted at the chief operating officer level and director level on multiple projects. And us personally, we're investors first with our projects and our investors, we've averaged over 30% returns in the last 5 years. But I always have to remind people that's not indicative of future, earnings, because real estate can be risky, especially on the development side, which we do as well. So that's a little bit of the background. And then we're here in Wolfboro, New Hampshire today, America's oldest summer resort, where we have lived since 2000. And like I said, my wife and I started in this 2018 more as a bit of a side hustle. She's managed properties, short-term rentals, long-term rentals. She's sold properties that were our properties, not as a broker, and done a myriad of other things. And then my son Jake was a real estate agent, and then he turned into a full-time underwriter and acquisitions partner. He took some accelerated real estate classes, so he deals with spreadsheets, and he's looked at thousands of deals over the last few years and does a bunch of stuff. And then my stepson Johnny, he produces our podcast and other creative things that we do whenever he can. He's an audio engineer and full-time musician. So, like I said, small family business, and we've just been having fun with it. So there's 3 areas of Froggy Companies, and they are, first and foremost, like I said, we're investors. We invest our own money, but we also invest other people's money in syndications. And we'll talk more about syndications for those that aren't familiar with syndications later, but I do manage a diversified fund, and we've done a lot of single asset syndication, that includes our investment money and partnerships investment money. So first and foremost, we do investing and partnerships in investing. Secondly, we do real estate development. Now, we've managed large developments in Michigan and Colorado, but we made a deliberate decision within the last 2 years to only do real estate development that we manage, within our own area, New Hampshire, northern New England. So we recently finished a 24-lot subdivision project here in Wolfboro that we're pretty proud to have completed. And so the third thing is we do consulting for real estate investment firms and development firms, and that's a natural progression for me, having been a consultant most of the last 25 years. And we deal with systems engineering and other things to do with processes and improving processes and helping out. So why I believe in real estate investing. I'm going to give my little spiel on it at an overall level. First of all, real estate's accessible to everyone. So that's one of the things that drew me to real estate. In our everyday lives, everybody knows about real estate. We all have to either live somewhere or rent somewhere. You close your eyes, open them again, you're looking at real estate, right? So it's easily accessible in that way, and there's a myriad of ways to make money in real estate. So second reason I really wanted to get in real estate, all wealthy people have some investments in real estate. We'll say 99% of all wealthy people have some investments in real estate. Generally, historically, people with diversified portfolios have tried to have 20% in real estate. But the point is, this leads to the third point that we all know, is that the biggest driver of wealth throughout recorded human history has been through real estate-related activities, whether investment, holding, buying, renting. And so, like I said, we work together at all different levels with people who have, no money but just can find good deals, or people who have a lot of money but generally are too busy to understand and work on deals themselves. So that's sort of a little bit of an overview of why I love real estate. I'll talk more about that after our 2 presenters come on. Dr. Jeff, again, he's going to be talking about tax advantages. I mean, the debt-free doctor, he covers a lot of ground in his channel, but specifically, I asked him if he talk, for the purposes of this first webinar, talk about some tax advantages of real estate, both for passive investing, people that just put money in and someone else manages, or active investing, because there are tons of tax advantages to real estate, especially if you're actively involved, but there are a lot of good ones for passive investing as well, and ones that frankly don't exist for other types of investments based on the way our laws are set up. I'm glad you joined us. I was going to start tap dancing. You're right on time. I said, I'm going to have to be talking about tax advantages, but thanks for joining us. I've given a little spiel about you. I've told people you've got, almost 6,000 subscribers at your YouTube channel. I love watching your videos, and the reason why I reached out and asked you specifically to talk about tax advantages of real estate was because you're so articulate at breaking down complex things, usually on a whiteboard. I like that in your videos. I'm old school like that too. But so Dr. Jeff, like I said, I've been calling you the debt-free doctor too. I love your website name. I've already told everyone you're a periodontist in Louisiana. I mean, if you want to take a minute and tell us, how you got into real estate, what you love about it, and then we'll jump into tax advantages if you don't mind.
Yeah, I actually got into it by accident. About 10 years into practicing, I hurt my wrist, and as you can imagine, it's kind of hard to work on patients without a hand. And I'd already gone through the Dave Ramsey's 7 baby steps, to where I'd paid off the $300,000 in student loans, paid off that first house, and I just thought, hey, I gotta work till I'm 60, or most of the dentists around here work till they're like 70, 75. So that was that's what I thought everybody did. Until about 10 years into my practice, I was about 40. My kids were 8 and 6. I hurt my wrist snow skiing. And that was really my wake up call to go, hey, I'm operating financially very risky. I'm only relying on one income stream. And if it goes away, I'm sunk. I didn't know what to do. So then I had like a deep dive on the internet, started looking at what really wealthy people did. And I could take that 6 months of research and basically boil it down into 2 things. Number one, the wealthy people, as you can probably imagine from this webinar, they invest in real estate. At that time, I had 0. And then number 2, they had multiple income streams, averaging 7 to 9. And I only had 1 at that time. So that really helped me narrow my focus. I needed to invest in real estate for multiple income streams.
Okay, perfect. And I love how you articulated that. And I've heard that before. And I know you also have, I don't know if you can call it a mantra, but passive, tangible, and proven. 3 things I've seen you talk about related to real estate. Mm-hmm. But that makes perfect sense to me. A lot of high net worth, most investors that I've had over the last 5 years are high net worth earners, doctors, lawyers, engineers, professionals, people that do have the one stream of income, like I have most of my life as a consultant as well. So that makes perfect sense. So now I know you could talk about multiple areas, but I'm gonna let you go into investor tax benefits and how I want to drive the discussion a little bit, and then you could take it any way you want. Because I know you're really well. I know you're not a tax professional, but I've learned a lot from you watching a couple of your videos. I want to talk about. Can you talk about tax benefits specifically to passive investors first, and then you can delineate between passive and active, and then we can go a little bit further from there.
Yeah, and again, like you said, I'm not a tax professional. I just go by what my CPA tells me. But the majority of the projects that I do are syndications. And is your group familiar with what that is?
Yeah, most of us know it's syndication, but go ahead, break it down, because I was going to talk a little syndication later, but go ahead.
Okay. Basically, it's a group investment that typically would be a little bit larger than one individual could invest in. So let's say it's like a $5 million mobile home park or RV park or apartment, something like that. Well, the majority of the people can't invest in that or buy one of those themselves. So they go in as a partnership. And I guess the best analogy to explain it would be like getting on an airplane. I think most people are familiar with that. And you got 2 types of people on the plane: the pilots, which basically get us to where we're going, and then the passengers. And the pilots on the plane are like the general partners, the syndicators, and they're the ones that do everything. They go through the pre-check menu, pre-flight menu, they make sure everything's safe. They get us from destination A to B. Syndicators, the same thing. They do everything for us. They find the deals, they get the debt on the deals, the financing on the deals. They get the limited partners or the passengers to invest, just kind of like we have to buy a ticket to get on the plane. They get them to invest in the deals, capital. So we just pay to get on the plane, pay to get into a deal, sit back and relax and enjoy the flight. And they handle all the heavy lifting, and they handle all the dealing with tenants, any type of renovations. They pay us quarterly, sometimes monthly, send us a check. So that would be the best way to describe it. But the cool thing about it is we get to reap the benefits, the cash flow, the tax benefits, the depreciation, the appreciation in the property, cash flow, like we were actually active owners, like we actually, own the property ourselves, but we get to do it passively. So I guess that's the easiest way to explain it.
Great analogy. I've never heard the airplane analogy, but I'm going to lift it from now on. I'll be using it tomorrow. Thank you.
Sure. So probably the biggest tax advantage of real estate syndications or real estate in general is depreciation. And I guess the easiest thing to describe it would be, your cell phone. And your cell phone, is probably $500, $700 if you have the latest Apple. I'm an anti-Apple person. I do all, Galaxy, but everybody in my family is Apple. It's probably $1,000 right now, right? But if you wanted to sell your Apple or Android 5 years from now, are you going to get the same amount for it? No. Are you going to get more? Unless Steve Jobs used it, probably not. So it's going to be less. It's going to depreciate in value, which is what one of probably the biggest tax benefit that we get in real estate is depreciation. The IRS allows us to write off the wear and tear or the property going down in value, just like your cell phone going down in value. But here's the crazy thing. There's no other asset class out there. There's no other asset that I know out there that the IRS will allow you to depreciate an appreciating asset. I mean, think about that. So not only is your investment, so, like your cell phone is going down in value, think about your cell phone if you buy it and it goes up in value, but you get to write it off. It's kind of like that. So the property tends to go up in value, just like, for those listening or watching, if you've bought a house before, if you've actually sold your house, you probably sold it for more than you paid for it, because typically over, depending on what study you read, real estate goes up anywhere from 2 to 5% or more. And with it going up like that, it's really cool that the IRS allows us to get to write off. Well, and again, I'm not going to go real deep here because I'm not a tax professional, but if you get into a property, if you own a property, typically accountants will just put you on what's called straight line depreciation. That's quote the standard. And for most rental properties, it's 27 and a half years. For commercial, it's 39. And what that means is probably the easiest math is let's say you buy a property for $2.75 million, and you take $2.75 million and divide it by 27 and a half. Well, that's what, $100,000 a year. So the IRS allows you to write that property off, to write off $100,000 a year over that 27 and a half year time period. And so that's the straight line depreciation. Well, there's something called accelerated depreciation so let's take an apartment. So if you look at an apartment, there's different parts of the apartment that are going to wear out in different time frames, right? It's not all going to wear out in 27 and a half years.
Absolutely.
Right? So your cabinets, the flooring, the painting, the landscaping, it's all going to be different. So the IRS actually came out with a depreciating, like a accelerated depreciating schedule. And what you could do is get what's called a cost segregation study. And the goal is a group will come in, like an engineering firm, there's cost segregation groups that'll come in and they'll segregate out the cost of each of these different components of your property into 1 year, 5 year, 7 year, and 15 year, not the 27 and a half years or 39 years. Because I know that's a lot of stuff, but think about it this way. Let's say you get into a syndication. Who wants to wait 27 and a half years to get all the tax benefits? Nobody. I just bought a Cybertruck, Tesla Cybertruck. I ordered it August 2020, and I just got it. I didn't want to wait 4 years.
4 years.
I waited 4 years for that thing. I wanted it then, but I didn't. So we're not going to want to wait 27 and a half years. We want to get all of those benefits up front. And when you get this cost segregation study, they allow you to accelerate, and you get all of that depreciation. So an example would be the majority of the different properties that we do are RV parks, and we own 24 RV parks, and we own 6 mobile home parks. And the reason I'm using that asset class is because those are if you look at self-storage, single-family homes, apartments, you're allowed to accelerate the depreciation more on those, anywhere from 60 to 80% of the purchase price year one. And this is coming from my CPA versus, an apartment like 15%. So for instance, if you buy $1 million RV park, 60 to 80%, $600,000 to $800,000 of the purchase price, you're able to deduct year one, versus like an apartment, 15%, which is about $150,000 on $1 million year one. And the thing is with depreciation, whenever you get it and accumulate it, if you don't use it all, it just rolls over to the next year. So the goal is to get as much depreciation as you can, and then just let that continue. That's like a snowball, let it roll forward. And that depreciation, so it's called a passive loss. Passive losses offset passive income. There's not many things out there that you can invest in that are literally tax deferred or tax free. So my strategy is I figured up how much money we spend every month. Let's just say it's 10 grand a month. Okay. That means I need $10,000 a month after taxes to pay for my household, goods and everything to live on. Well, most people, if they need 10 grand to live on, they'll need to earn anywhere from $18,000 to $20,000 a year, a month, pay taxes on it, and then have about 10 grand left. Okay. So that's what most people do. They work their W-2, 1099, and they make all this. Let's say they make 20 grand a month. Well, they're going to pay almost 50% in taxes, federal and state. Then they got 10 grand left over, versus investing in these types of projects. And when you make 10 grand, you can offset that $10,000 with depreciation, and you still put the 10 grand in your pocket.
Yeah, that example would be zero tax on that, right?
Yeah, exactly. So
Continuously
literally,
offsetting,
with me, I didn't get into real estate to buy a Cybertruck, to buy boats and cars and whatever. I did it more, and really any goal that you have, whether you want to lose weight, you want to have a better relationship with your spouse, you want to invest in whatever, you have to have a strong enough why. Simon Sinek's book, Start With Why. If you don't, you'll quit. My why was I had to do something to provide for my family if I couldn't practice anymore. I lost money in deals early on. I lost 50 grand in a syndication deal. I got screwed over by people. It didn't stop me because I knew that I had to do it. Luckily I have a high enough income as a periodontist where I could make those mistakes. Okay. But if I could go back, I would do things totally differently, knowing what I know now. And that's what I'm doing now, is teaching other people literally how to do this, hopefully mitigating the mistakes from what I've made.
Yeah. No, I'm with you absolutely. The cost segregation and then you didn't even get into some of the bonus depreciation you did, that you could do that all in the first year, is phenomenal. Especially, I know when you couple that with 1031 exchange. Somebody is asking a question here. Is there any advantage to voluntarily deferring depreciation to the next year?
I don't think you can. I'm not an accountant, but I think whether you take it or not, I think the IRS, and I could be wrong, but from what I've read, you have to take it, for each year.
You have to take it the first year. So you'll be showing passive losses, basically.
Yeah.
You could show passive losses, but like you said, it rolls over. You show losses for 3 years. And then the third year, you make $1 million, but you had 600,000 losses. Now you're only paying $400,000 capital gains tax in theory, right?
Yeah, here's an easy scenario, and this is kind of the typical scenario. Somebody invests $100,000 in an RV park syndication, one of ours, okay? They put in $100,000, and we pay them an 8% preferred return. We're paying them $8,000, okay? 8% of $100,000 is $8,000 quarterly. $8,000 divided by 4 is $2,000. So they're getting $2,000 a quarter. So they got $8,000 of passive income year one, and they've got about $60,000 to $80,000 in depreciation from year one. Well, think about that. Over 5 years, they're going to get $8,000 times 5, $40,000, and they'll have enough depreciation from that one deal to offset all that income. And think about it, if you do this every year, if you just do one property, one syndication a year, you're going to keep acquiring more and more depreciation. It's going to roll forward. And then when you look up, like we are, I'm luckily I'm at right now, I've been doing this for about 8 years. I've got all these different income streams coming in, and I have way more depreciation to offset it. And telling you, it's the most freeing experience you treat your job differently. You're not worried about money. I mean, people come into my office, they're working 2 jobs, they're busting their butt, they really need this work. I help them out. I'll give them a big discount, or I'll do it for free or whatever. But if you're stressed out, you have a lot of debt, you only have one income stream, it's hard to do that. And that's really fulfilling for me as well.
I can imagine, but the depreciation example is phenomenal. And essentially, you're saying if people are passively invested, they're benefiting from that because they're on the plane, they're on the bus, and they're getting those same benefits. There's Zach on board. He's our next speaker. Listen in, Zach, and then we'll be getting to you in about 10 minutes. So the depreciation. So I wanted to take it a step further. If you're a real estate professional on top of that in the active, then you have even more advantage, right? Can you cover a couple advantages that other ones besides depreciation that you didn't get to?
So you want me to talk about real estate professional status?
Yeah, or anything, qualified business income deduction maybe, is some things I've talked about. The fact that you can use tax-deferred IRAs, which we'll be talking about later, or maybe 1031 exchange, all these different areas I know you know about. But
yeah, so with the 1031 exchange, so that would be, you could do that with regular property, or you could do that with a syndication. So for instance, I'm in a syndication that I got an email the other day, and it said, hey, we're getting ready to sell this apartment complex. You got 2 options. Number one, you can cash out, and any of the depreciation will be recaptured and you have capital gains. But again, talk to your accountant. If you have depreciation, it can help offset all that. Or you could stay in the deal in 1031 exchange. So basically you're rolling all those profits over into a new investment. And when you do that, you avoid all the, the capital gains and taxes and that sort of thing. And if you just own property outright, you could do that as well. I've got a business partner, and him and we own 6 mobile home parks together, and that's all he does. So he's constantly looking, before we sell a mobile home park, he's constantly looking, and there's a time frame that you have to go by. I believe it's like, by the time you are ready to sell, I think it's like 45 days to identify. I think up to 3 properties.
45 to identify, 180 to execute.
Okay,
right?
180 to execute.
Days. And so for those people that don't know 1031 exchange, can you just fill them in on what that means? A couple of the rules around it.
So you can defer capital gains taxes. You have to reinvest the full amount on that next property, and it has to be equal or larger value. So if your property was $100,000 initially, the next one has to be equal to or more. It can't be like a $50,000 property. It's got to be more than that. When you do that, it resets depreciation. And again, you can continue to diversify your real estate portfolio like that. But yeah, like you said, 45 days, within 45 days of selling, identify up to 3 properties, and then you have 180 days to buy 1 or more of your listed properties.
Yeah, that's a great.
And then I
that's a
can
great
give you
metric.
my experience being a real estate professional. Most of the high income professionals are busy, and it's usually the spouse, the non-working spouse, or the part-time working spouse that can qualify. And when you do this, we talked about before, your passive losses can offset passive income. But when you become a real estate professional, the IRS says your passive losses can offset passive income plus your active income. And that, my friends, is the game changer. Because
Yeah.
imagine you not having a tax bill anymore. A lot of I've got the guy, I think he's an allergist in Georgia. And he called me this year and he said, I'm going to have a $980,000 tax bill this year. My wife is a real estate professional and I need to get about $1 million in depreciation. And he dumped about $1 million in our projects. So instead of writing a $980,000 check to the government, he wrote a $980,000 check into assets. So he didn't have to pay. So now he gets to keep all that money. Plus that money is now making him money. I mean,
That is
that, my friends, is how the rich get rich and stay rich. And the rules around that are you have to work more in your real estate trade or business than you do your job. So, but if your spouse, is 750 hours a year or 15 hours a week, roughly. And if your spouse does that, or if you can do that, so let's say you work 30 hours a week doing whatever you do. That means you have to work 31 hours or more a week on your regular job. Excuse me, 30 or 31 hours a week in the real estate business. So you have to work more than that. But once you do that, and your accountant can help you with making sure that you qualify, and you have to document everything if you're ever audited. But that's the game changer. But most of the people that we work with, they're usually the 750 hours is hard. Usually they can do the short-term rental tax loophole, and you only need 100 hours. There's 7 different material participating tests. Material participation means you have active involvement with your real estate, with your property. And there's 7 different tests, but you only have to, you basically have to meet only one of them. And the one that
only
most,
one out of the 7.
one out of the
Okay.
7.
What I want to circle back to the short-term rentals, Jeff, and thanks for explaining that, because you could see the snowballing effect and the power of being involved in real estate that no other industry has these types of tax advantages, even close. Someone's asking the question, can you 1031 exchange from a personal property sale into a syndication?
As in your personal residence?
I'm assuming that's what they mean.
Yeah, I believe it has to be rental. It has to be rental property. I don't.
Oh, so it has to be an investment into another investment,
I
not your. You think so?
Yeah. I don't. I don't. I'm not sure, but everybody that we've dealt with has been, because it has to be. It's the 1031 like kind exchange. It has to be like for like, so it has to be like rental property for rental
Like in
property.
kind. Yeah. So Jeff's saying not likely, but check with your accountant on that question. So now the short-term rental, briefly, we still have a couple more minutes here. I wanted to understand that aspect. Like what do you mean about there's like these 7 areas? Because you're doing RV parks, is that why?
No, that's
do-
just
is that what-
some people, they'll come to me and they'll say, hey, like for instance, we had an orthodontist that was looking to get into Airbnbs, short-term rentals, and he wanted to
Okay.
know the tax advantages around it. They wanted a vacation home, basically. And so the IRS basically allows you to offset your W-2 income, just like the real estate professional status, as long as you meet, again, certain criteria of that. So basically, let's say you buy a beach house in Destin. That's like $1 million, okay? So
Okay.
when you rent it out, there's certain things that you have to do in order to meet the requirements to use this loophole. The average stay of a customer is 7 days or less. Okay, and then the average period used for the property as a whole is 30 days or less. 30 days or less, and then a significant part of it has to be like personal services, like daily cleaning. If you do meals, so it's the IRS looks at Airbnbs as more as a hospitality type thing because you're really involved. It's not like you put a tenant in an apartment and they stay for 12 months. Like you're turning this over. So
it's more like a hotel. It's more like a motel.
Yeah. So let's say somebody stays for 8 days and they stay for 5 days and they stay for 2 days and they stay for 10 days. That's fine. But when you average it all out, it has to be 7 days or less. And when you do that, then your rental property is no longer passive by default. Again, you don't get to qualify as real estate professional status, but you are able to turn those losses into non-passive losses, which can offset your W-2 income. And you have to meet one of the 7 material participation tests. And most people, they typically will meet the 100-hour test. And that's basically you participate for at least 100 hours that is equal to or more than anybody else that's participating in your property. And so that's really not that hard to do, especially if you're answering questions or marketing or whatever. And then you can set up the same thing. You can do a cost segregation study. You can use that to offset your W-2 income. Again, work with your accountant, but that would be a much easier way to use depreciation to offset your W-2 income than the real estate professional status.
Okay, thanks for explaining that. And I think there's even something where you can like buy into a short-term rental or, like you said, a vacation home like that towards the end of the year, and it would still count, right? Like,
I think as long as it's got to be in service before the end of the year, and I think you want to get your cost segregation study done. You want to get it literally as soon as you buy it, and then that way, a lot of times people reach out to me like in September and October, just like you said, and like, hey, I got a $200,000 tax bill. What can I do? It's like, well, you ever thought about getting into Airbnb? No. Well, what for? And then we walk them through that.
Yeah. No, it's smart. Well, hey, Jeff, thanks for coming in this evening and sharing some of these tax strategies with us. Like I said, for people here and people online, go to the Debt Free Doctor anytime. Jeff's got tons of great videos, and you saw tonight how he could just break them down really simply for us. So I really appreciate it. You could stay on the line if you want or drop off. Make sure you let those links upload, and then I'm going to bring in the next speaker to talk about SDIRAs. But it's been great talking to you, Jeff. Thanks a lot.
Hey, Jim. How are you doing?
Hello, Zach and Jason. As promised, our next speaker, Zach Silver with Jason Prezant. I think Zach's going to do the talking. Zach's actually got a presentation. He's going to pop up on the screen here and run through it, and then we can ask him questions right after. Okay, can you guys see that in the back okay? Yes, everybody can see you, everybody can hear you. Go for it, Zach.
Perfect. Well, yes, thank you so much, Jim, for having myself and Jason on today. We're very excited to be a part of this webinar and educate individuals about self-directed IRAs. Really our bread and butter. We do this every day, every second of the day. So yeah, my name is Zach. I am with Madison Trust Company for a little over a year now, and I'm joined here with my team member Jason.
Nice to meet you all as well.
Yeah, and today we're going to dive into self-directed IRAs and some benefits and the processes. So I'm going to jump into it first with what is a self-directed IRA. I know some people may know about it, but a lot of people don't know. So I'm going to first start off with what is just an IRA. An IRA is an individual retirement account that the government gave to us so that we can have a tax advantage type of account to save up for our retirements. And the most traditional types of accounts out there are a traditional IRA and a Roth IRA. And they have their tax advantages. As a traditional is a tax deferred account, which means you're not getting taxed on your funds until you bring them out of your account and distribute it when you retire. Or you could have a Roth account, which is my favorite type of account. I personally have this type of account. It's a a tax-free type of account where you pay taxes when you put the money into that account, and it's completely tax-free all the way up until you take it out. So it's always tax-free when you take it out in the future. There's no penalties, there's no taxes ever, and I see it as the most beneficial type of retirement account to have. So the regular IRAs out there, everybody knows about big name companies like Charles Schwab and Fidelity and Vanguard and such, and they have these types of IRAs, but they kind of limit you onto what you're allowed to invest into. So at those types of companies, you're really only investing into stocks, bonds, mutual funds, index funds, those mutual funds, and all these publicly traded investments. And it's really great to get into those, obviously, but it's also great to get into some alternative investments that could possibly bring you a better return than the market really brings people. And these types of alternative investments we typically see are most commonly, I would say, real estate, investing directly into real estate properties and purchase them as a whole, or you can invest into a company that does real estate investing, so you can reap the benefits of that by pooling money together with a company so that you can get a better return on that. And there's other types of investments like private placements, private REITs, promissory notes, lending people money, and there's precious metals, obviously, and also there's even cryptocurrency, which some people are a fan of, some people aren't a fan of. So yeah, these are all the different types of things you can do with a self-direct IRA. The list goes on so much more. We have seen people invest into Arabian racehorses before, and I'm telling you, they're making a lot of money. So maybe you guys should look into it.
I think
But
you can invest in
yeah,
you can
so
invest in wine as well.
yes, definitely. You can invest into so many things. There's just a few things that you can't, which are things like insurance, or if you're in a self-direct IRA, you can invest in publicly traded stocks, and yeah, you can't do any illegal paraphernalia like marijuana companies because that's not a federally legal investment to make. So there's only a few things that you can't invest into, but most things you actually can. So that's really what a self-directed IRA is. It allows you to diversify your portfolio and really get into the alternative space with those retirement funds. So now, Jason, tell us a little bit about the process here of what it looks like to have a self-directed IRA.
Absolutely. So to set it up, it's really just a three-step process. So it's opening the account, funding the account, and then getting all invested from there. Opening the account, it's only about a 10-minute application, 10 to 15 minutes. So you just follow that online on Madison Trust, and then from there, once you're all set up, then we work on getting the account funded. So whether you're rolling over funds from a previous 401k, transferring from a self-directed IRA, from a IRA somewhere else basically, or just contributing funds, either which way, getting that funded would be pretty quick. And then after that, getting invested. So Jim already sent in everything, so the investment's already pre-approved. So from there, you guys would be easy to flow right into this investment from here.
Yeah, definitely. It's a super easy process to get into. The online application is so easy to complete. Funding the account is a little bit challenging sometimes, just because they have to deal with your 401k plan to tell them to mail a check, and it might take a week or so to get over here. But we try our best to make sure that we can be full assistance throughout the entire process, so that it is not challenging. It's not a headache for you.
Yeah, thanks for explaining
and
that,
then,
Jason. So yeah, before you go on real quick, like I said, we're obviously not like a timeshare sales event here, but if anyone's excited about it, like I know I would be if I still had money in a 401k or a bunch of money in the stock market, watching it go up and down like a yo-yo. You can obviously, like you said, we've already got this set up with the Froggy Fund that we'll discuss later for you to roll over into shares if you're a credit investor. So thanks, guys, for setting that up. Go ahead, Zach.
Of course, yeah. So I want to just put a quick disclaimer out here. My team and my manager always make me do this. But yeah, we are a passive custodian, so we're not allowed to advise our clients on exactly what they should do or what's a good decision to make or what's a good investment to make. We do advise all of our clients to make their own decisions and talk to their own tax and investment professionals before making these decisions. So it's great to do your own due diligence. We just do the due diligence as in making sure you're making a legal investment, but we don't do any risk analysis of any sort. And then that brings me into this slide right here. It's one of my favorite slides. It's really what's the actual benefits of utilizing a self-directed IRA. So obviously I mentioned it before, the first one, portfolio diversification. Obviously a lot of people in their retirement accounts diversify into a bunch of different stocks and bonds, and that's sort of diversification, but true diversification is really getting into an alternative investment class besides the publicly traded investments out there. And this is a great way that you can do that. When you're moving funds into a self-directed IRA, you don't have to move your whole account. We typically see that when we have a client come to us, they don't move their whole account. They just move a partial amount of their money from their IRA or their 401k over to Madison so that they can make one simple investment into a startup company or into a real estate company that they really believe in and that they see will succeed and bring them very good returns. So it's just a great way to diversify, take your eggs out of one basket, put it into another, and really try to succeed and grow your retirement wealth. And that kind of brings me into my second point. It allows you to have that hands-on investing. It allows you to invest into things that you're more in tune with. A lot of people that are in that room and that are watching this after the fact probably know Jim on a personal level, know about Froggy Companies and what they're about and what they're doing, and they could talk to Jim about what the plans are and what the returns are going to be, and it gives you a better understanding of kind of what you're investing into instead of just clicking on a stock and investing into it after doing some analysis of it beforehand. You actually get to see the process and where your money is going, so it allows you to really hands-on invest those funds into something that you really are passionate for. And the third point here, stability. The stock market is very volatile. Like Jim was saying, it goes up and down all the time. And sometimes there's companies out here that can be a lot more stable than the stock market is, and you could absolutely know how your returns are going to turn out in however many years you're deciding to invest with them. So it's a really great way to diversify, get some hands-on investing, and possibly get a more stable investment than just a stock in the market. And now I see a question real quick. Is a self-directed Roth IRA possible, and is there a benefit? So yes, there is a self-directed Roth IRA. So the four types of IRAs you can create at Madison Trust Company is self-directed traditional account, a self-directed Roth account, a self-directed SEP account, and a self-directed simple account. The SEP and the simple are a little more in-depth that you could do some research on, or you could schedule a call with us after the fact about it. They're more for self-employed individuals and things along those lines, but the most common ones we see are the Roth and the traditional, obviously, because if you are moving funds from one retirement account to another, then they do have to be the same tax advantage type of account. So you can't just have an IRA that's a traditional type of account and put it directly into a Roth self-directed IRA. You can decide to do a Roth conversion, which means that you pay taxes on those traditional funds, and now you never pay taxes on them again since it's now in a Roth account, which is a different different topic for a different day, which you could definitely talk to us about because we're happy to help out with that. But yeah, those are the four types of accounts.
Yeah, good question.
So yeah, very good question. And now, Jason, tell the viewers here kind of what sets Madison Trust Company apart from other self-directed IRA custodians, because we'll be honest, we're not the only ones out here.
Sure. So a lot of what we do here, we focus on what the clients want and need. So first off, client support. Anybody here, whenever you call in, you're always going to be talking to a person. You're not going to be having to deal with robots. Some of the other places you go to, you might have to. Here you don't. You call in, you're talking to somebody. The fees are straightforward. We have them straight out there, very easy to follow. And that's really our big selling point there is those competitive fees, client support, and you have a knowledgeable employees here. I mean, people are CISP certified. We understand what you need, what you want, and you can just call them with any of those general questions. We're happy to help out here. The other thing is Madison Trust, we've been around since 2014. We have built up to over $4 billion under custody since then in 10 years. So we've exponentially grown. High retention rate, over 95% of our clients stay with us for the long term and across all 50 states here. So we really cover you wherever you're at, no matter what. So you can definitely look us up on Google reviews, Better Business Bureau. We're all over the place, and 5-star reviews all over, no matter where you go.
That's why I invited you guys to talk. I appreciate it. And my experience with you
Yes,
has
Jim.
confirmed that as well. Very, very on top of things, very helpful in the way you got it set up so that people could, invest tonight if they wanted to through you guys. But I have a question for you. I have a solo 401k, and that's what I rolled my money into. Do you guys do those as well, or is that the type you do?
Yeah, I'll let Jason answer this one.
So actually, on top of the self-directed IRAs, I'm actually the solo 401k individual here as well. So hey, any questions, we can always talk about that too.
Perfect. One thing I'll point out that I just learned, and what I love about the checkbook control with the solo 401k, and why I would never go back, is I have the ability, especially at my age now, I'm 53, I can dump a lot more money into a solo 401k per year than I could into an IRA, right? Do you know the numbers?
Yeah, significantly higher.
I'd be like,
And when age is 50 plus, you have a nice catch-up.
yeah, exactly. So it's really, yes, tax deductible. Got another question. Go ahead. Yeah, good question. I think I know the answer, but can you invest in an up and coming company with a self-directed IRA?
Yeah, so that's actually besides real estate, one of the most common investments people make are with startup companies. I see a bunch of like biotech companies, science companies that are creating technology, and they're startup companies that have some friends and family that would like to get into it on the early stages before it really blows up and possibly becomes public in the future. So it's 100% possible, and this is a very popular thing people do because that is a great way to expand your retirement account because the returns can be exponential.
Excellent. Good question. I mean, and technically you can invest just like you are with other stuff in the stock market, right? I know during COVID, I went into my solo 401k and I just played around and like tripled a small amount. I didn't do it with a lot, but stocks aren't my thing, but it seemed like it was easy to pick out certain things, and it like tripled over a little time. So it was kind of fun to play with, but so you can do venture capital with it. And I'll share with everybody something I just learned as well, because silver, we buy a fair amount of silver as a family. Mostly it's collectible and for nieces, nephews, grandchildren. But the precious metals part, I think some people think that they can just buy it and store it at home. But I saw where some
Great,
people
yeah.
got busted. I saw people did that in Florida. They got busted for like a large amount. They had to pay like $400,000 in taxes. So do you know any other rules around that? How are you supposed to do it? What are your options with your precious metals?
Yeah, so that's an amazing question right there. We actually have a relationship with a precious metal depository. So we have an area where if people are looking to purchase precious metals, they'll have a very simple, easy process to do that. And this depository will keep their metals in storage because you're not allowed to personally have these metals in your possession, as that's a prohibited transaction within an IRA. So it's very important that we have this relationship. We do this on behalf of the clients so they don't have to go out there and try to find some place to store it in, some depository to store it. We have a great relationship with a very trustworthy company, and they have been great ever since we've been working with them.
Great. Thanks for giving more information around that. One other thing, you probably covered the documentation required from investors. What is that?
Yeah, so this is a great question, especially I know Jim here is raising capital right now, and we actually got the documents from him beforehand, and these are just company documents that we usually take when we are doing a pre-approval or just an approval of an investment. Our company looks for the purpose of the company, such I was saying you're not allowed to invest into certain companies. So we look for the purpose of what the company is doing business in. We look for different things along those lines and what the deal is going to be. And then we do that IRS compliance review of the documentation, the company docs that we will let you know. And we will also be of assistance in getting if you're investing with Jim, we already have them. Luckily, if you have a different investment environment in the future, then we can assist you in reaching out to your company in mind and getting the documents for you. or pretty much the company documents, and then there's always going to be some sort of document where you're going to have to sign. And most of the case, it's a subscription agreement. So we actually got a blank subscription agreement from Jim so that we can assist any of the individuals that might be attending this if they are interested in utilizing their funds to invest with Jim through a self-directed IRA here. We have everything pre-approved. We have the subscription agreement, and we could help you out because there's certain titling coming through a self-directed IRA that you will have to use, such as if it asks for your name, you're not going to just write your first and last name. You're going to put Madison Trust Company FBO, your name and your account number. If it asks for what your title is, you're going to put IRA account holder as your title. If it asks for your social security number on the document, you're going to put our company EIN number, and it's also going to be our domicile address in Sioux Falls, South Dakota, our headquarter address for that. So yeah, it's really important that we have these documents and we're able to assist our clients in filling them out correctly.
Good. So my attorney was worth it then.
Yes, definitely.
We got pre-approved when we went to Zach and Jason on that. So yeah, thanks for covering that. We mentioned the fees. I know I have your fee schedule, but you do have like some of the most competitive fees. Can you just cover what those would be? Like, for example, if I were going to roll over and make a $50,000 investment tomorrow.
Sure, absolutely. So the nice thing is about Madison Trust, whether you're investing 10,000 or 500,000 plus, it's flat rated. So no matter what you're investing, it's $105 per quarter, aka $420 per year.
That's it?
No, that's not all of them. There's some transactional fees, and we're also happy to send out the fee schedule to anybody really interested. There's certain fees such as wire fees that are $25 for incoming outgoing wires. But let's say you invest with Jim and you spend $25 to wire him the funds. Let's say Jim is providing you distributions quarterly, or if he's providing distributions just in general, Jim could decide to do you a benefit and send us a check or an ACH in your regard, and that's actually free of charge, so you won't be charged that incoming wire fee of $25. So you really only have to worry about the $25 when you're sending wires. But if Jim is nice enough, maybe he'll send a check to your account over
Absolutely. It's a deal. We'll do it.
And then when you're doing an investment, we do have our investments team review all the documentation and make sure that you fill it out correctly, because we don't fund any investments until all the paperwork is in good order. So we do charge a fee for that because we make sure that you're making legal investments, and we do our due diligence on your behalf so that you don't have to worry about it and don't have to worry about the IRS coming after you, because nobody wants that. So we do that review of the documents. We make sure that you fill it out correctly and everything is in order, and we do charge a $50 fee for that when you make an investment.
All right. Thanks for explaining that. So again, everybody, the self-directed IRA, it's a miracle thing to me. The 401k, even better if you're a solo member, single member LLC like most of my companies are. Really good to do, and Madison can hook you up in any of the 50 states. Here's Zach and Jason's information, and as you know, we're going to be replaying this webinar and sending it out on social media. But these guys are super helpful and easy to work with, and I've worked with different IRA places and 401k places in the past, and they're at the top of the list. And if you put money in there, I just recommend it no matter what. If you don't do real estate, you just have more flexibility over your own money, your own retirement account, whether you're going to invest in guitars, in wine, in companies. I'm getting some thumbs up over here, or real estate, our preferred asset class. So.
Yes. Thank you, Jim. And then I see one question in the chat here. I just want to address it.
Go ahead.
I see it says, are there any overseas regions / countries in which you cannot invest with the self-directed IRA? So that's a great question. Here at Madison Trust Company, you cannot directly invest into a fully foreign company. So if a company is fully located in a different country, then you can't invest into it unless you have maybe a solo 401k set up, because that's a checkbook control option. Or we also have different options such as an IRA LLC. You're allowed to create an IRA LLC and invest through a self-directed IRA into your own LLC and have full checkbook control just like a solo 401k. It's just a little bit different. But within those brackets, then you're allowed to do those types of investments, and you're also actually allowed to start trading stocks and bonds as well within an IRA LLC, which is very beneficial for some people who want to keep everything in one account. But yeah, those are two options to invest into fully foreign companies. But if there is a foreign company, which I've seen before, that is headquartered somewhere else in a different country, as long as they have a sort of a presence in the United States, such as an office, and they have an American bank account, then you actually can invest with them. It doesn't have to be headquartered and run inside of the United States. As long as they have some sort of U.S. presence that we could send the money to another U.S.-based account, then it's actually totally fine to invest with that.
That is good to know as well, because we do a little bit of international investing ourselves. Thanks, guys. Unless there are any other questions for Zach and Jason, I really appreciate you guys coming together over last week and pulling together this information and helping us out a lot. And yeah, so I talked a little bit earlier about why I got excited and got into real estate. Now I'm going to talk a little bit. First, I'm just going to cover, our diversified approach with the Froggy Fund 1 that's open. We have this fund open. It's open for up to $18 million. Shares are $50,000 each. And we have a number of sponsors, a number of assets that we're going to invest that money into as a syndication. But in addition, I'm going to talk after that about other ways we can work together, because a lot of people want to ask, hey, I'm not accredited. How can we do stuff with the Froggy Companies? And whether you're accredited or not, there's lots of stuff we could do. What we can't do is we can't go out and advertise publicly for big deals to non-accredited people. But we can always joint venture with people, just like joint ventures happen all the time among people who know each other. Family and friends you've known over 90 days or who've been on your mailing list can come to you with $5,000-$10,000. So before I jump into the Froggy Fund, I'll just give an example of that. So if you knew me or were on my mailing list back in 2022, I would have told you, hey, we're doing a land-related deal here in Wolfboro, and we're going to invest money. And if anybody wants to put in $5,000-$10,000, what we need is $50,000 to get this off the ground. And we're going to have this opportunity to rebuild a road in town and pay off some old taxes, and then we're going to sell lots or do spec homes, right? So if I had given you that sort of pitch from our mailing list because you knew me in advance before 2022, and you had taken me up on that, the $50,000 that you invested, or say you invested $5,000 in June of 22 when we did our last deal, then 18 months later, your $5,000 would have been $50,000. Because we did a 10x on that. We turned the $50,000 into $500,000. So that's a home run. Doesn't happen all the time, but it did in that case. If you had been around in 2018 when I first started as a general partner in a deal and had put money into a Mesa, Arizona deal, and you didn't have to be an accredited investor at the time, you could have been a sophisticated investor, and say you put $20,000. 2 years later, you would have had $35,000. So there are all kinds of these ways to get involved where you don't have to be an accredited investor. And in many cases, one thing we're doing is privately, we're setting up a pre-development type of entitlement fund, because in the world of acquisitions and development, lots of times the earliest money can get the biggest payoff because you're part of the general partnership out of the gate. If you've identified an opportunity and you're willing to put in some small amount of money at risk in the riskiest part, which is up front, then you have outsized returns above and beyond the limited partners. So I just wanted to point that out as something. And then we strike up relationships all the time with people that have no money to invest in real estate, but they live in some area of interest, or almost any town can be of interest, and they're willing to go out and look for deals and find deals, and then just come to us and say, hey, you want to invest in this? I found X, and we can do a deal that way. So I wanted to talk about that first. Now I'm going to get into the Froggy Fund 1. So all of us ask this question at one time or another, especially today. How safe is our money, right? So today we all have many of the same economic concerns. We're worried about inflation. We're worried about geopolitical instability. Worried about these elevated interest rates, especially in the world of real estate and stocks and bonds. And you have your basic set of options. This might not be all inclusive, but you can hide your money under your pillow. You could save it in a bank account. You can invest in bonds or stocks, securities, digital blockchain assets, precious metals, some of the stuff we talked about that you can do with self-directed IRA. Or last but not least, you can invest in real estate. Here's our thesis, and we're not alone. We're not alone in believing this. Real estate, we believe, is the safest, most proven solution to the difficult problem of how to keep your money safe. It is safer and ultimately more profitable than most alternatives in the long run. So the chart you're seeing here, the green line is real estate from 1800s through 2012, and the black line is equity return in this case, equity in like stock market. And you generally just tend to see in the stock market this volatility that doesn't happen in real estate at the same rate. And the reason why is because it's a stable investment over time in general. There's a lot of tangible data around that, and because real estate generally tends to move slow and is generally illiquid, so that even when bad things start happening, they usually happen in a slower manner than they do because, as we all know, like the stock market, for instance, is very emotional based, and that's why people say, well, leave it, let the money sit longer. If you have it like an index fund, you'll be fine. Over the long term, maybe you'll come out about the same, but in general, it's a more volatile play, stocks versus real estate. And here's another indicator of that. This chart on the right, the return on investment, is just from 2000 to 2012, and you could see how real estate outperformed NASDAQ, S&P, and Dow in this time. And that's even counting the huge real estate burst, bubble, whatever you call it, of 2008, 2010. Real estate still caught up and outperformed these other investments. So you're much less likely to be caught in short cycle downturns inside of real estate. And you can also be patient in real estate just like you can in the stock market. And that happens in development a lot. So the point of this chart is, and I stand by this and I've learned it, both in theory and in actuality, and that is that the real estate industry is resilient. There's opportunity in every stage of the market to invest in real estate. There's never a bad time to invest in real estate. There are bad deals, and you can get caught going in a bad deal, and you can leave your money in too long, or you could start development. Now, development is riskier on the spectrum than an existing cash flowing asset. So if you're left between an option between the two, in general, our opinion is you always want to go with a cash flowing asset if you can, but they're harder to find good deals than some development deals in some cases. There's just a lot more variables with development. So you can see this line of where generally you have 20-year cycles historically of, supply and demand changes, of where people build a bunch in some area, and then because there's not enough housing, and then it's oversupplied, and then vacancies go up, and then you go back down the cycle when supply growth is higher, vacancies go up, and you're back to the beginning where suddenly space is difficult to find, rents rise rapidly, and demand growth continues, new construction. So it's perennial, and every stage of the cycle, there's unique opportunities that pop up. And that'll play into part of our philosophy I'm going to discuss here. So what do we bring? Why do we advertise, hey, come invest with us? And it goes back to what Dr. Jeff Anzalone was talking about. When you do syndications, it's like you're asking people to get on the back of the plane, because in this case, we are the pilots and co-pilots, and we are experienced at what we're doing, and we're asking you, can we win your trust? Can we win your trust based on our experience and our transparency and our track record? Come try us out. So in our case, myself. I'm the fund manager, along with another guy named Colby Bowers, who is online virtually tonight. But Colby and I are both Air Force veterans, and so we're a little no nonsense when it comes to focusing on our mission, I guess, as you would see it. And our Colby's focused on residential acquisitions and management for the last 7 years, but he's been doing real estate investing for the last 24 years. Myself, I've been involved in mixed-use development mainly, but also some acquisitions over the past 5 years. So we're both experienced in that way, mainly in single asset and syndication experience. In this case, we're doing our first fund of funds, and I'll get into what that means a little more in a moment. But we've both gone full cycle with outsized returns. I alluded to some of that before. We realize the importance of strong, transparent management and decision-making, and we're opportunistic. So our fund isn't based on like, we're just going to invest in Denver or Nashville or Gainesville, Florida. Or we're anywhere in the country and any asset class, because the deals are more important. The sponsors are more important first, followed by the deals, then followed by the location and all the other metrics that you need. So lastly, unlike larger management firms, we believe we have flexibility to move quickly, and we don't have to perpetually find something to invest in that might make us want to move too quickly. So what we do with our fund is we ask for people to commit, make tentative commitments. When we get enough commitments, like right now in our fund, we'll make a decision to go ahead and invest, allocate tranches as we've got X amount of commitments. So we won't pull the trigger earlier than we need to. Our execution strategy then, in a nutshell, is we have relationships with elite sponsors, and we continue forging new partnerships every day. And every single one of our sponsors has long, profitable track records. And I'll talk about some of them in a minute. As discussed, we're trying to diversify risk and return profiles. In this case, with this fund, we're going to maintain a strict balance between stabilized cash flowing assets and then opportunist high reward developments. For example, like an industrial project. We're recently, not with this fund, but we're partners, we're small partners in this case with an industrial deal here in New Hampshire where we think it'll be all in at $4 million, and we expect that to cash out at around $12 million within 2 years. So sometimes you have these high reward opportunities come up that you want to put in the mix with these other things, and again, it sort of diversifies what you're doing in your portfolio. So the area where we shine personally with Froggy Companies is due diligence, based on a career of doing hard analysis and systems analysis. And we, in the real estate sphere now, we run all our partners and opportunities through a highly detailed, multi-tiered due diligence system that we've spent years, reassessing and improvement. And lastly, like I alluded to before, we're going to be investing in resilient markets and asset types because we want to be relatively immune to macro instability of what's happening across the country at any given time. There's always pockets of good places to invest in if you know what you're doing and take the time. So our greatest value is found in our partners. And here's just a few of our current and past partners. And you can check them out. I'm going to distribute this presentation to everyone here and anyone on our mailing list. So make sure you hit us up on email or social media and ask for a copy of it. It's also on our, when you go to froggyfunding.com, if you sign up in our investor database, we have copies of this presentation. But I'm going to talk about these partners in just a moment. Again, so this is me. It's a picture of me without the beard, without the glasses. But you can see I've had over 30 years experience. I've done acquisitions, syndications, development, program manager, hundreds of millions of dollars of program management experience, and now both in military, homeland security, and real estate. So my main thing is focusing on systems and optimization of teams. So that's me. And then Colby, here we got a retired Air Force combat medic, who I'm proud to work with, Colby Bowers, and he's just a great guy. Colby's out there in Montana. Like it says here, 23 years of distinguished service. He is a wounded combat medic, and he is just good to work with. But in addition to his military service, along the way, he picked up rental units, and now since that 2017, his partnership has acquired over 1,700 rental units, mainly out west. They're doing some cool car wash deals now as well that aren't part of our portfolio, but he's, in addition to Colby's distinguished career and professionalism, he just gives a ton of his money away to different special purposes, veteran organizations and other charities. So happy to be working with Colby on this. And so here's an overview of this fund that I've been talking about. It's up to 18 million. That's what we're going to cap it at. Target IR internal rate of return is 15%, and that's annualized. And we're going to try to hit that. Like I said, what's unique about this is we're doing this with cash flowing assets, where the quarterly distribution starting in year 2, which will be roughly 50% of our portfolio, and the other 50% should be ground up development that you'll be accruing an 8% preferred return along with your annualized return, and then the payout in those won't come until later, right? If it's a for sale project or you build it and start renting it, then money will start flowing there. So a couple other things here. So you see Permanis. I worked directly for Permanis when I made a lateral move. My mentor, John Bogdasarian, runs that group, has a stellar track record overall since the last almost 20 years now, or 15 to 20 years. And they're doing a really cool project in downtown Nashville, one of several they've done in a row successfully. They're ground-up condos. We're hoping to be able to put some capital into that deal. Sunrise Capital, experts at mobile home parks and parking decks. They've got 27, 28 quarters in a row of cash flow out of those deals. They know exactly what they're doing. Vivo Investments, great guys over at Vivo. They're probably the leader in the country right now of hotel to multifamily conversions, and they know what they're doing mostly in the southeast. Roots is a super up and coming group out of Atlanta, and we've struck up a relationship with those guys over there now. Roots, investwithroots.com. You can go and invest in their REIT for as little as $50. They have a great program going with the rentals, but in addition, we have the opportunity with our fund to get involved in the home flipping that they do, called Flipside, where they go and acquire the homes and flip them into the REIT. So there's a couple opportunities to get involved with Roots, and they have just a bunch of good things going around how they do their business. And last but not least on this list, at least, is Mission Bay Capital, who another Air Force veteran, Daniel Woodford out of Virginia. He and some very experienced guys, and I've done deals with Daniel in the past. And he's an experienced syndicator, but in this case, he's got some unique land deal opportunities in Northern Virginia. So, Daniel, I think in Gainesville, Virginia, Daniel's got a land subdivision deal going on there. We'd like to put money in that as well. So, a target investment length for our fund, this particular fund, remember, you got to be a accredited investor in this one, and it's up to 5 years. But this is kind of what we're up to right now in terms of our fund. So, besides going and open up your self-directed IRA, if you want to go into our portal and sign up here. If you're accredited or not accredited, you can go to our Froggy Fund investment portal here that I'm showing and sign up, because you can be on our newsletter. I think we're up to somewhere between 100 and 200 people on that newsletter now, and with a bunch of more potential accredited investors signing up weekly into our funds. So, contact us anytime there. And I think that's it. So I'm going to knock down these slides and see if I can answer any questions. Now I see some questions. Okay. Are there full particulars of the investment portfolio available? Yes. That link that I just put up before shows details of what we plan on investing in this portfolio. I kind of went through them just now, so Jason, hopefully you heard some of those. but you could see it's sort of a timing thing. For instance, if we hit certain metrics, like say we hit the first million next week, we wanted to wait till we got 1 million committed, and then we put 200,000 maybe into 5 of those things we just talked about: Sunrise Capital Mobile Home Fund, Ground Up in Nashville, the Mission Bay project in Virginia. So that's kind of how we're working that. It's not like an existing portfolio that someone would invest in. It's a strategy of a set of sponsors that we deal with. We're going to call this a webinar. Okay, they're getting rowdy in here. I really appreciate you guys joining us. Email us anytime or check us out on social media, including subscribe to our Froggy 5 YouTube channel. Thanks again for joining us tonight. You guys take care.